Good morning, everybody. Hope we're doing really good today. Welcome back to the channel. In August, I sold a few puts, and now a few of these puts are being assigned to me. I got 4 puts being assigned to me. They're in the money. Today's expiration, and they're far enough in the money where it's probably not likely they're gonna have a little rebound and go out of the money. So I'm gonna be taking possession of these shares today. Now, I prefer selling puts, and I don't want to be assigned, but it's part of the wheel strategy, where you sell puts, then you get assigned, and then you sell calls until they get called away. And one school of thought is that if you sell a put on a company that you really like, it's a win-win situation and you can't lose. But I don't agree with that because you can still lose money on selling puts on even quality companies that you do want to own. An example would be if you sold a strike price of $30 and you get 75 cents in premium, your new cost basis is $29.25. If the shares are trading at above $30, your shares expire worthless. If they're trading in between $30 and $29.25, you are assigned shares, but your cost basis is low and you're still profitable. But if those shares are trading below $29.25, below your cost basis, you're still losing money on buying these shares. Your account value is still going down. So once your shares are assigned to you, there's a couple things you can do. And that's what we're going to talk about in this video. We're going to look at my puts that I have in the money and what my options are. Before we do that though, if you're new to the channel, I'm Justin. I like to talk about dividend investing, income from options, financial independence, and I'd really appreciate it if you get anything out of this video to give this video a like and subscribe to the channel if you haven't also. I'd really appreciate that too. All right, let's go into my account, look at these options and see what I'm gonna do, okay? All right, here are the contracts that I have expiring today. I have this Bank of America put. It's going to expire worthless, but we're kind of close with the underlying 25.35, but the put is worth strike price at 25. So when market opens in a couple hours, I'm going to go in and buy to close this for this $6. Now, our contracts that we have in the money is a CVS put, $62.50, Kroger, $35, Walgreens, $40 put, and an XLE, which is the energy ETF, $36. And the underlines are right here. So they're all in the money. Now, if I wanted to buy to close these right now, here are the prices. It would cost me $400. $407 to close out CVS. We have Kroger, $537, Walgreens, $272, and XLE, $219 to close these out. So it costs about $1,436 to close these all out if I didn't want to take possession of the shares. But it's the wheel strategy, so the plan is to take possession of the shares and then sell covered calls after that. But like I said, we do lose money if these shares are assigned to us when they are less than our cost basis. So right now, the difference between the share price and the strike price for CVS for my account is $359. For my Kroger puts, it's $498, $250 a contract. Walgreens is $279, and XLE is down $200. So I need to come up with like $1,300 to get back to even. And this isn't including premium. We'll look at the cost basis here in a minute. We'll look at the cost basis next. So we take our strike price, premium, and then that's our cost basis. So cost basis for CVS is $60.98. Our Kroger $34.30, Walgreens $39.13, and XLE is $35.27. So we need to get some more premium to get that underlying cost basis down. A lot of people like to sell weekly covered calls, and some people like to sell monthly covered calls. If you do 4 weeklies, it does add up to more than 1 monthly. But there's some other things involved, and that's kind of why I like monthlies more than weeklies. So we have CVS. We could sell, what do we got? Maybe we could sell this $59.50 for, would that be what? Maybe 48 cents, 45 bucks. Subtract the premium from our cost basis of $60.98. That would give us $60.50. But if this gets called away from us, then we'd still lose about $100 on the contract altogether. We could sell multiple, maybe this doesn't get called away and we could do it again next week. But let's look at the monthly and see how that looks. We could do this $62.50. That would give us, $47 in premium or so. That would be the same. That would bring our cost basis to $60.50 or so. And then if it gets called away at $62.50, we get like $200 in profit doing that over the course of a month. So that sounds a little better to me and a little safer than having these shares called away early and having to take a loss. One other thing that's cool with CVS, if these shares don't get called away from us in this next contract, it goes ex-dividend around October 23rd or so. So we would be eligible for the dividend after that, and that's pretty cool. So we're going to definitely sell the monthly contract on this one, and maybe even if it doesn't get called away, we'll be eligible for the dividend after that. Now, same thing with XLE, except for XLE has a dividend, and it usually goes ex-dividend at the end of September. So sometime next week, we can expect a dividend from XLE, goes ex-dividend, and then maybe a payout at the end of the week or so. It's usually about 50 cents, so we can count on that to reduce our cost basis a little bit. And then we could sell this $35 strike price with another 70 cents or so of premium there. Take that 70 cents, $34 is our new cost basis. And that would leave us $100 if this gets called away at the end of, in the October expiration. The cost basis for Kroger's $34.30. So we got some, get like 22 or 23 cents of premium from a $33.50. But I really don't like the odds. I don't want to keep selling contracts. I want to get my cost basis down. So we're just going to go straight to our monthly contracts. So we sell the $34 contract. That would bring our cost basis down about 47 cents. Something like $33.83. And that gives us something like $17 per contract. So $34 profit if this gets called away in October. Cost basis on Walgreens, $39.13. We sell this $40 contract. Say 60 cents. 60 cents out of that would be about $38.53. That would give us about $140 profit if this gets called away at the $40 strike price. So the biggest thing I'm doing right now is I'm trying to reduce my cost basis. And then if I can sell the contract for far enough out, if the shares go up and they get called away, that counts as profit, and that will reduce my cost basis, and the positions will be profitable. Now later, if I can reduce my cost basis to where this will be profitable, these positions will be profitable, I can sell weekly covered calls to get that extra premium once I'm not too worried about my cost basis anymore, because I know it'll be profitable. So that's the plan. Get some dividends out of XLE, sell monthly calls. Maybe if CVS does not get assigned, get called away, I'll get some more dividends out of that, get my cost basis low, then sell weeklies to get more money and not care if they get called away. And hope you get something out of it. Give me a like if you like this video, and subscribe to the channel if you haven't. I'll post some other videos over here that'll be really cool, and I'll see you in the next video, okay? Maybe Monday or so, all right? Monday, Wednesday, Friday. See you in the next video, okay?